What we're going to be looking at is what losses teach you and how do you try and learn from them. Now, people try and avoid losses in trading. They spend a long amount of time trying to stay away from any losses, stay away from any kind of risk, and their focus is towards that. That's the wrong approach. You don't want to be scared of losing. The simple solution I always have for people, if you don't like the idea of losing, just don't put a trade on. You can't lose money if you don't take a trade. Equally, though, you're never going to make any money. So you have to accept that you're going to take losses. And losses are useful. Losses help you recognize not just trades that haven't worked and how to improve them, but things that are starting to change. Just to give you a little bit of insight, most traders over the course of a year, and I did this for the entire group last year, average around about 52% loss. So people are losing more often than they're winning. It's not about how many losses you take and try to prevent losses. It's about what you learn from those losses and what you do with those winners. So we'll get to that towards the end of the session. I'll give you a very clear example of the difference between how you maximize winners and the impact that that has on equity performance. Right. But what spurred this whole idea on of discussing how you learn from losses was that mid-April, we had two, let's put it bluntly, stinking days. We've not had two consistently bad days of the same kind of scale in the last, well, nearly 18 months. So we go all the way back to Jan 2022, no 2 days consecutively have managed to lose that amount of money. This is pretty bad, or it at least seems quite bad. What you've got to look at then is, well, what are you learning from this? What are you gaining from this information? Because just spotting some down days doesn't really tell you anything. So we need to go and investigate, well, what's caused these losses? And we'll come on to the specifics in just a moment. This is what it did to April performance. So this is where those losses come in. Very, very negative looking situation. That takes us down into the negative, which just about recovered by the end of the month. So it's a pretty flat month, basically. Somewhat disappointing for a lot of traders. So what causes losses? And this applies in a wider and a narrow focus. Any loss that you take has basically two components of varying degrees. Now, these are basically a psychological, I don't like to call it a deficiency, but something in your mind has prevented the trade from working or got you into a trade that turns into a loser. An example of this would be a situation where you haven't really planned what the trade is and you've seen a market starting to go to the upside and you thought, you know what, I'm just going to buy it. That's a classic example of FOMO, of this kind of psychological trait that you want to be part of it. And so that's what's causing the loss. It's not a technical understanding, which is the other side of losses. People will lose money from a technical perspective, often early on in their careers, simply because you don't understand enough. You haven't seen enough different examples of certain types of setups, of certain types of action within a market to be able to recognize one trade that will work and one trade that won't. So with any kind of loss, and this is more of a tip for anybody, whenever you look at a loss, look at it from the perspective of what technically could have been improved, or what technically did you do just right on that trade? And also from a psychological point of view, what was your thought process when you took that trade on? Was it clearly planned out? Did you know exactly what your purpose of the trade was, where your stop was, where your target was? Your stop and target is not necessarily purely technical. It's also psychological. Are you giving yourself a small stop so that you don't lose much money? So I'm always looking at any kind of loss from those two perspectives when you're looking at an individual trade. You can also look at this from the perspective of what's going on for a wider, a wider perspective, excuse me for repeating. Take technical. You could have a situation where you're not seeing the same types of reactions. So data's not doing the same as it was. Correlations aren't changing the same way. That's a technical thing. You can see that happening. You can also, from a psychological perspective, from a market psychology perspective, see that a market is becoming quite lethargic. What was once generating large amounts of activity, great amount of participation, is no longer doing it. Trades do not flow in the same way that they do. A market lacks what I would call kind of commitment to movement. I've seen this a lot the last few days in in European bonds in particular. European equities a little bit less so, particularly today with the rally that they put in. So losses aren't just telling you about individual trades. Losses are telling you a more broad story, a story about market environment, a story about how things are changing and how you then need to adapt. What often happens, and without going into too much detail, it's a concept that I explain in much more detail, and anything I kind of try and teach people is that strategies essentially get crowded because everybody understands the strategy. What you also have is a situation where narrative changes. Markets don't care so much about a certain story or a certain piece of information. Take, for example, SVB. That was a massive deal in March this year. Is anyone talking about SVB anymore? No. Granted, I know that they went bust, bailed out. Essentially, the bank stopped being a bank in the same way. But that story's moved on. So the care is not there. That narrative has gone. So what a loss is telling you about as well is how the environment is changing, how markets are now reacting to any incoming news, incoming information. So what caused these losses? Well, the two big moments on these 2 days were the US PPI data, which comes in lower, and the US retail sales data, which comes in lower as well. Now, in the recent environment that we've had throughout 2022, coming into the beginning of this year, lower numbers, particularly for the S&P, have been very positive. The reason for this, and this is how you have to interpret data, this meant that the Fed was not going to raise rates as fast. If you got lower inflation numbers from the PPI, lower retail sales numbers, i.e. that they were running the risk of a recession, the Fed is less likely to raise rates. So the S&P rallies, theoretically. And that worked very well last year. But you're not seeing that. You look at what happens over here, the S&P chops up and down, and then very, very slowly rallies by the end of the day. So if you're buying it down here, you're taking yourself way onside, offside, and then eventually it goes. You can't hold on to that. But then you get the opposite here, where again, S&P should rally. You don't get it. Retail sales goes down, continues to go down, and then finally turns before going down again. So there's no consistency in the action. You take this onto bonds. PPI does what it should. Lower PPI data, that reduces the probability of a Fed rate hike. Bonds rally. That makes sense. Retail sales, the complete opposite. Very, very heavy sell. Now, retail sales being low should very much be a buy for bonds. Less chance of rate hikes, bad economy, that's a buy for bonds typically, and it's not worked. So this then suddenly creates these big losses. This is telling you a story. So rather than just sit there and go, oh, the market's beat me, everything's unfair, it's all changing. It's telling you a story, right? So a situation's changed. You're not going to make the money trading a certain style of trade that you have been. And this is consistent over time. What you get, and I'll explain the little chart in a moment, is that over time, performance in a certain strategy, so let's say buying equities, buying bonds on negative data, works. Now, as time progresses, everyone cottons onto this trade. This trade then becomes crowded. Everyone's trying to do the same thing, which means that your performance then starts to drop. So if you look at the green line is performance on each trade. Hypothetical. I'm drawing it as a kind of an explanation. So on a trade, you might start losing, a strategy starts to work, you start making money, wonderful. But over time, that strategy stops working. What initially happens is you stop making as much money. You don't just suddenly stop making money. So your performance, your equity on a certain type of strategy continues to grow, only much more slowly. It's only once you start getting negative performance that this then actually starts to take a turn to the downside. So that's a really important concept to understand. But as you're seeing this type of progression, as you see that your performance on a trade has been going up, and then starts to wane, that's giving you a clue that environment is starting to change and that you need to now start adapting and generating new strategies, new ideas. I know what some people are going to be thinking, and some people are going to be thinking, well, if I can see this coming, why don't I just stop taking the trade on? It's an easy thing to say. I'll explain it a little bit more, Daniel. So take any kind of strategy, take any individual strategy that you're trading. If you imagine the performance on each strategy, so each time you take the trade, Over time, the better you get at taking that trade on, and particularly when supported by an environment that suits that type of strategy, your performance per trade, the green line, will increase. So you'll make more money each time you take that trade on. Over time, that trade will stop working so well. So you'll stop making money at the same amount. So let's say you learn new trades, you make 200, then you use that strategy again, you make 500, you make 1,000, you make 1,500. Over time, that will stop working in the same way. You then start dipping back. You're only making 1,000, 750, 500. That doesn't mean that you're losing money overall. It just means that your equity, the red line, is not going up as quickly. So the equity, the red line is essentially the cumulative of all of the points along the green line. That's essentially the way to be looking at that. This happens to any trade. No strategy lasts forever because strategies are contingent on participants acting in the same way every time, and also a market environment moving in the same way that it does. Looking for a trade of a certain number of ticks doesn't work all the time because volatility is going to impact that. So one simple thing that many people will look to do is try and predict the end of this and go, okay, well, I'm just going to stop trading that strategy. This is where losses are good. The reason that a loss is good is because that then says to you, this strategy may no longer be worth trading. If you try and guess the end of a certain type of strategy working, you run the risk that you stop trading a strategy here because you think, I don't think it's quite working in the same way. Maybe I should stop trading it. The problem that you have there is, yes, maybe you're not going to make as much money on each time that you take that trade on, but you're still making money. So your equity would continue to grow. Whereas if you try and predict the top, what you're doing is you're giving yourself a massive opportunity cost. Yes, you will take a loss at some point, but taking a loss here on the back of already making all of this additional isn't so bad as taking the loss here. Yes, maybe it's not super negative in impact, but it's a bigger impact. You've got to weigh opportunity cost against losing. Losing is not a bad thing. Losing at least says that's the end, rather than trying to guess the end and never knowing quite where the end of a certain type of strategy working comes. The opportunity cost is greater. And if you do stop here, what you really run the risk of is then starting taking on that strategy again here when the payout on it is getting much less. So never try and guess the end of any kind of strategy working or the end of a certain type of situation playing out in markets. You need that loss to say to you, yeah, now's the time we can stop this. The point here being you maximize an opportunity to the very end.